Welcome to the Chartered Financial Analyst Level 1 series of videos. As usual, an introductory slide about my qualification and experience. Today we will continue our discussion on the corporate finance and equity, and this is the video number 12. In this video we will continue our discussion on the cost of capital. In the last video we started the evaluating or estimating the cost of debt. In this video we'll continue the cost of debt, and then we will introduce how we could find out the cost of preferred stock as well as the equity. So let us begin. In the last video, the video number 11, we started our process of estimating the cost of capital for different types of capital, mainly the debt on the preferred stock and the common stock, that is the equity. In the last video, we started the discussion, as I said, about estimating the cost of debt. There are two ways to estimate it. The first one, which we had in the video number 11. The second way of estimating the cost of debt is called the rating. We use the rating process. There is agency that rate each bond. When the company issued a bond, there is Fitch agency, Standard & Poor's agency. This agency look into the financial statement of the company. It studies the affair of the company. It inquires from the directors. They do a lot of work and then assign rating. Rating started from AAA, that is the best one, with very low risk, and then it goes down to 2A's, 1A, then B, 3B, and on until C, D. If the company is rated D, then we call it, this is a junk bond and it's very high risk. In this case, the company will pay very high interest. But if the rating is very high, AAA, the company will be able to pay very small cost of debt. So based on the company debt rating, we can estimate the before tax cost of debt by using the yield of comparable rated bond. We see the other bonds in the market which has comparable rate, AAA or AA, similar to our rating, and then we use that as approximation. But we must be sure that we take bond with a similar or close maturity. If we are issuing a debt for 10 years, we should look at comparable or similar companies with having the same rating and close maturity, either exactly 10 years or 9 or 11 or whatever. But we can't take 2 years maturity and compare it with 10 years maturity. So let us take a small example to see how we could do that. Suppose a company's capital structure has a debt of bond that has average maturity of 10 years, and the company's marginal tax is 35%. If the company is rated AAA, the yield on the debt with the same debt rating in the market is 4%. That is, companies having bond issued, and these companies are rated AAA, and the bond maturity is 10 years, they are currently paying 4%. So if our company is going to issue new bond or new debt, and we are triple rated, and the debt is 10 years or close to 10 years, we can safely assume that our cost of debt will be also 4% before tax. If I want after tax, as usual, we multiply by 1 minus tax rate. So the after tax, 1 minus tax, cost of debt is 4% times 1 minus 35%. This will give 2%, 2.6% after tax cost of debt. In this way, we can estimate the cost of debt, either approach number 1, which we had it in the video number 11, that is the similar yield to maturity in the market, or similar debt rating approach. Now let us move next to the cost of debt. There is some issues while estimating this. It's not that simple. We just see similar rating or so. Let us see the issues in practice where we face while trying to estimate the cost of debt. The first issue, there is fixed rate debt and there is floating rate. Some debt they pay fixed rate of 2%, 3%, or whatever the percentage, the whole life of the bond, 5 years, 10 years, or whatever. There is other bond that pay floating. Floating, it depends on the LIBOR. We explained what is LIBOR in previous videos. LIBOR plus a margin. LIBOR keep changing. This is called floating rate. So which one we use if it is floating rate? Should we fix it? If it is fixed and we are going to issue a floating rate, which one to use? This is one issue. The other issue, there is some debt which is having some option. Like for example, the company might issue bond giving the holder right to convert it to stock, or to repay it earlier at advantage or discount or premium. There's so many features that is attached to the bond. So it is rarely you find a bond with the same features, with the same debt rating, with the same maturity, so that you can use it. In this way, we just take an estimate. There is some companies who have non-rated debt, companies that has no rating, neither A or B or whatever. It is not rated. How to use it? Should we assume that it has the same rating? That is an issue. Lease also is a type of debt, but it has no publicly known cost, or it is just also an estimate. Now let us move on to the preferred stock as one of the shape of capital structure of the company, because the company could be financed by debt or common stock or preferred stock. The preferred stock normally pay dividend. So if we have a non-convertible, that is a preferred stock that cannot be converted into common stock and become permanent or part of the shareholders' equity, there is no such right. And it is non-callable. That means the company has no right to call this option, that is to repay it earlier than its time. And let us assume also that it pays fixed dividend of 5%, 4%, or whatever. So how to calculate the rate? You could say simply, if it is paid fixed dividend of 5%, this will be the cost. Unfortunately, this is not the case, because the preferred stock could be bought and sold at different values. So we'll take the market value based on the preferred stock value. We pay fixed $2, but $2 divided 50 is different than $2 divided 30, depending on the market condition. We use this formula to estimate it. Price of preferred stock means equal dividend of preferred stock divide R. Do you remember the golden rule that keeps coming from video number 1 until now, where I call it the central concept in finance? The value price equal cash, that is the dividend paid, required rate of return R. In this way we can find R and we call it the cost of preferred stock. Common stock, that is the equity, which is the owners of the company, is permanent. How we do this? We have 3 approaches to find out the cost of equity. The first one, to estimate the cost of equity of a company listed in the market or not listed. There is different means, but let us see. The first one is the capital asset pricing model. It has this equation, which I explain in more detail on the video number 9. please go back to video number 9 on the playlist titled CFA Level 1 course within the channel. This is my YouTube channel. You will find this video number 9. There is detailed explanation about the derivation of this equation. How do we get it? It is the required rate of return by equity, which is the cost for the company, the risk-free rate of return minus plus risk premium. The risk premium is the market return minus risk-free rate of return times beta. How we calculate the beta? Also in the video number 9, there is a detailed calculation using Excel. We went to the website of Yahoo Finance. We extracted some data and we did calculate the beta there. Please refer to that. Also, after we get the cost of equity using this capital asset pricing model, we add some macroeconomic factor like inflation, like that is specific to certain countries, the risk of, for example, legal risk or whatever type of risk. We keep adding it to the cost of equity. There is also factors that is specific to our company. We estimated beta from the market, but there is some specific factors within our company that either mitigate the risk so that we lower it by a factor, or it increases the risk and that we need to add after we get required rate of return by equity, let us say 10%, and we have company specific factors that makes our company more riskier than the market, then whatever we get, the 10%, we can add 1% estimate and use 11%. The second way is dividend discount model, which is this dividend we pay cash divide required rate of return. This is again the golden rule. Wherever you go in finance, you will be chased by this equation. Price of the equity at time 0 today equal dividend next year time 1 after 1 year divide required rate of return, but we minus the growth in dividend, because dividend is not fixed. If you buy a stock today that pays $8, let us say $2 every year, this $2 keep changing. The company increases its dividend year after year. We see in 5 years how much it has increased its dividend and by how many times. Let us assume every year it increased by 2%, or sometimes 2%, 5%, 3%. We get the average increases. We call it growth in the dividend payment. We minus the growth from the required rate of return, and then we can calculate the cost of equity. We are concerned about the cost of equity. That is, we are looking for R. Let us assume we know that the market price of the shares today is $10. It pays a dividend of $1 every year. That is $1 dividend. Minus divide R, which I'm looking for. I don't know. R of equity, that is required rate of return of equity, RE. We call it R sub A. So minus gross. I read the data, previous history of the company payment. I will find out G. What is left is only R, the cost of equity, and I can find it out using this formula, which is basically value equal cash I receive divide the required rate of return. Sometimes we use the bond yield of the company plus risk premium. That means bond is less riskier than the stock. Don't forget we are trying to estimate the cost of equity. Equity is more riskier than the bond. So if the bond pays 5%, I would say equity will require risk premium of 6% over and above the 5% currently being paid by the bond. So 6% yield on the bond plus, 5% yield by the bond, that's the bond pays, plus the risk premium of 6 will give 11%, and I use this as the cost of equity. Let us move on and consider some topics while estimating the cost of capital for everyone. For example, beta. While determining the beta for the project, we will be faced along the way with certain decisions that we need to take. The first one is the estimation period. In the video number 9, which I referred to just now, we use 5 years return of the stock to estimate the beta of the company. So some people will say, no, we want annual data. Some will say every 3 years. Some will say we need 10 years. So how much the period I should take? Also, another issue is the return interval. For example, in the last video again, we estimated the daily return. Some company use weekly return. Others use monthly return to calculate the beta. So which interval should we use? That is a question open to judgment by each company. Which market index we use? Beta means how the return on our stock react relative to the change in the market index. But what is market index? Again, in our video, we use the S&P 500 index. Some might say, no, we should use NASDAQ because our company is in the IT sector. Some might say, no, we are a manufacturing company, we should use the Dow Jones Industrial Average Index. There is a German index, British indexes. Within America, there are so many. So this is another issue we need to decide while estimating. The smoothing techniques, that means there's some fluctuation, sharp fluctuation or outliers, changes in the market. For example, in one day, the company might announce something that will result in 15% increase in one day in the stock market. But on average, the stock increases by 1%, decreases by 0.5% this way. So the 15, we need to smooth that. There is so many techniques to use, which is judgmental. Also, small capitalization stocks, there is a strange phenomena discovered by Professor Eugene Fama. He's a Nobel Prize winner. He called it the small capitalization effect. That is, beta normally doesn't work well with small companies. The problem with the small companies is that they are more riskier than the normal companies, big companies. This is why the estimate of beta is always give a return less than the actual. The small companies produce return higher than what beta predicts. So there is an issue here with the small companies. There is other risk. We don't know how to factor that risk into the cost of capital, such as the business risk. What is meant by the business risk is the main core business of the company. Is it dying industry or is it growing industry? The business risk is about the product the company provides or the service they render to their client. If there is no demand for their business, this is called the business risk. The financial risk, this is like foreign currency translation risk. There is interest rate fluctuation also risk. There is cost risk with keep fluctuating. The huge debt in the company's capital structure is also produces financial risk. That is the risk of bankruptcy, which means basically that the company may not be able to repay the debt or the interest on the debt. There is also other issues besides estimating beta, the issue relating to companies that are not publicly traded in the stock market. So how much its value? They pay dividend, but we don't know about because the information is not public. It is privately held. In such case, there are so many issues we use. Pure play, that means we use comparable companies. Let us assume we are concerned about a company that is privately held, is not publicly traded in the stock market. This company operates in the real estate sector. We could go to the stock market and see a company there working in the same real estate sector with similar size. We could use that as estimate of beta, for example. We should account for different leverage for both companies. For example, company A has a debt of 90% of the equity. 90% financed by debt, 10% financed by equity. Another company, only 10%, or let us say 15% debt and 85% equity. This is a capital structure. In the first one, we call it highly levered companies. The leverage is very high, 90% debt. The equity is only 10%, high levered. The other one, with the debt of 15% relative to the whole asset, we call it very low leverage company. How we account for that? We first calculate beta and levered. What that means? When we calculate the beta measures the all-in risk, including business risk, financial risk, everything. So if beta of a company that is highly levered, 90% leverage, is say the beta is 1.5. Now, I can't take this 1.5 and use it with similar company. If that company, for example, is 100% equity finance, it has no debt whatsoever, so the financial risk is very low. I can't take the same beta and use it there. I need to de-lever beta, to remove the effect of leverage from beta. So I get unlevered beta, and then re-levered it using the leverage of the other company. Let me explain it this further. Let us assume the first company, company A, had a leverage, that is debt, 90% of its assets is financed by debt. Another company is financed 15% by debt and 85% by equity. If I have the beta of the first company with a very high leverage of 90%, I need to de-lever and get the beta without leverage. And then use that beta and do a re-lever again, using the leverage of 15%, not the 90%. This is the meaning of unlevered beta and re-levering beta. But how we do this? I think we leave this to the next video. That will be video number 13. And as usual, please do subscribe. On the next video, you will get notified.